The interplay of interest rates and bond yields. Decoding the basics. Interest rates and bond yields are intricately linked in a dance that reflects broader economic conditions. At the heart of this relationship is the concept of opportunity cost. When interest rates rise, newly issued bonds come with higher yields, making existing bonds with lower yields less attractive. Investors seeking better returns naturally gravitate towards these newer issues, causing the prices of older bonds to fall, thus pushing up their yields to align with the new market realities. Conversely, when interest rates fall, existing bonds with higher yields become more appealing, driving up their prices and consequently lowering their yields. Central banks play a significant role in this dynamic by setting benchmark interest rates that influence economic activity. Their monetary policy decisions are often responses to inflationary pressures or economic slowdowns. Understanding this interplay is crucial because bond yields serve as indicators for other borrowing rates, impacting everything from mortgages to business loans. Investors and policymakers alike monitor these movements closely to make informed decisions, navigating the complex landscape of economic and financial strategy. Bond valuation and the impact of coupon payments. Bond valuation is a critical component in understanding the forces behind bond rates and yields. It involves determining the present value of all future cash flows generated by the bond, which includes both the periodic coupon payments and the principal repayment upon maturity. The coupon payments are essentially periodic interest payments promised by the issuer, typically made annually or semi-annually, which serve as a primary source of income for bondholders. The impact of these coupon payments on the bond's valuation is significant because they provide a predictable income stream, rendering the bond more attractive to investors seeking regular returns. The value of a bond is inversely related to changes in interest rates. When interest rates rise, the present value of the bond's future cash flows decreases, leading to a fall in the bond's market price. Conversely, when interest rates fall, the present value increases, making the bond more valuable. Coupon payments also influence the bond's duration, which measures its sensitivity to interest rate changes. Bonds with higher coupon rates typically exhibit lower interest rate risk since they recover their investment more quickly through higher periodic payments. How macroeconomic factors influence rate fluctuations and bond yields. Macroeconomic factors play a crucial role in shaping bond rates and yields, as they influence investor expectations and central bank policies. One of the primary factors is inflation. When inflation is on the rise, the real return on bonds is eroded, prompting investors to demand higher yields to compensate for the loss in purchasing power. This causes bond prices to fall and yields to climb. Conversely, low inflation often leads to lower yields. Additionally, economic growth impacts bond rates, as strong growth can lead to higher interest rates set by central banks to prevent overheating. This, in turn, causes bond yields to rise. On the other hand, slow or negative growth can lead to lower interest rates and reduced yields. Central banks themselves influence rates through monetary policy tools. For instance, during periods of economic uncertainty, central banks may implement quantitative easing, purchasing bonds to lower yields and stimulate the economy. Finally, currency strength can also affect bond yields, as a weaker currency may necessitate higher yields to attract foreign investors, while a stronger currency may allow for lower yields. Market liquidity. Its role in shaping bond rates and yields. Market liquidity plays a pivotal role in shaping bond rates and yields, acting as a key determinant of the ease with which bonds can be bought or sold without significantly affecting their prices. In a market with high liquidity, investors can trade bonds swiftly and with minimal transaction costs, ensuring that bond prices remain stable and reflect the underlying value more accurately. This stability generally results in lower yields, as investors are willing to accept lower returns for the perceived safety and ease of trading such bonds. Conversely, in markets with low liquidity, the risk of facing difficulty in selling bonds at fair value contributes to price volatility. This volatility leads investors to demand higher yields as compensation for the increased risk and potential costs associated with trading in less liquid markets. Additionally, liquidity can be influenced by factors such as the number of market participants, transaction volumes, and the overall economic environment, further underscoring its profound impact on bond pricing dynamics. Understanding market liquidity is crucial for gauging the risks and returns associated with bond investments. Understanding yield curves. Predicting economic activity. Yield curves are foundational tools in predicting economic activity, offering insights into the future direction of interest rates and economic health. A yield curve is a graphical representation of the interest rates on debt for a range of maturities. Typically, the curve slopes upwards, indicating that longer-term debt instruments have higher yields than short-term ones. This shape reflects the risks and uncertainties associated with time, as investors demand higher returns for longer commitments. However, yield curves can also take on other shapes, such as flat or inverted. When the yield curve inverts, with short-term rates higher than long-term rates, it often signals that investors anticipate a downturn. This phenomenon has historically preceded recessions, making an inverted yield curve a powerful predictor of economic slowdowns. The yield curve acts as a barometer for investor sentiment, influenced by factors like inflation expectations, central bank policy, and overall economic conditions. By examining the yield curve, economists and investors gain valuable insights into potential shifts in economic activity, allowing for more informed decisions regarding investment and policy strategies.